Does take us to our talk of the tape. The road ahead for your money as stocks start June with a good amount of red on the board today. Let's welcome in Gabriela Santos, Chief Market Strategist for JPMorgan Asset Management, and Kristina Hooper, Invesco's Chief Global Strategist, both as you see here joining me at Post 9. Nice to see both of you. Okay, new month. What happens to stocks?
So I think what we've been seeing this whole year is that asset classes are still extremely sensitive to this back and forth of plain analogies, meaning the cyclical picture. During the month of April, initially in May, it was about concerns about a reacceleration in inflation, about potentially bringing back rate hikes, and that largely calmed down during the month of May. And I think we're really turning now into June into an environment where there's more concern on the other side about real economic growth. And for us, really, this is just a story of a moderation in the overall pace of growth. But anytime you're moving to a lower altitude, you can have some slightly more choppy air and some concern about too much deceleration. That's what we're seeing today.
Okay, you speak to, today, right, this data was not great. So bad news is bad news potentially for stocks. Do we no longer get the bad news is good news boost because we think it's just going to lead to rate cuts sooner?
I think largely this year it's been really a focus on why rates are rising and conversely why rates would be falling. An environment where yields are falling because inflation is moderating and the Fed is proactively starting a gradual rate cutting cycle is a good environment for stocks. But an environment where yields are falling because there's true concern about economic deceleration, that then is not a positive environment. So the why matters a lot. But I would just highlight here really this morning we got manufacturing data. All really that we're seeing with manufacturing, with home building, with autos, is until rates come down substantially, it's just going to be hard to get off the floor. And that's really not new information. I think we would really focus as the week goes on any news or any downside news around the jobs market and the very, very critical consumer piece of the pie here.
That says, though, to me, Kristina, that if, until rates come down considerably, that's the word that Gabriela used, that the broadening trade remains suspect, that you can't count on it until rates really start coming down. Is that fair? Am I wrong?
I don't agree. I think that there's a real psychological value to having one rate cut, to feel as though the Fed is moving in that direction. And I think that can do a lot, certainly for markets, which I'm focused on, but I think also it will help the economy. I think we could see some loosening of credit conditions. It could provide a little breathing room for real estate. I think it could yield good things. And I also do believe that it wouldn't be the only rate cut this year. I think the Fed could easily cut in July and cut again once or twice in 2024, not because the sky is falling, but because monetary policy is too restrictive given how much progress has been made on disinflation.
What if they don't cut at all, right? Barron's was out this weekend. They're not going to cut. You've obviously had expectations come way in. We'll ask Robert Kaplan in a little while what he thinks. But what if you get none? What if you get none?
I think that can be problematic because we do have to worry about those long and variable lags of monetary policy, which is why we had that apprehension and nervousness today. This is a softening of the economy that the Fed has orchestrated. The Fed now needs to start cutting, or else I do think there will be more concerns. Well, there will be more days where bad news is bad news if we think the Fed is resolute in not cutting. I just don't believe that's the case.